You found it. The perfect dividend ETF. High yield. Popular. Thousands of people buying it every single day. You're about to click buy, and then something stops you. What if I told you there's one number, one single metric, that most dividend YouTubers never show you? And it's the exact number that determines whether your investment is actually growing over time or quietly falling apart while you collect your monthly payments. That number is called total return. And once you understand total return, you start noticing something most dividend investors completely ignore: NAV erosion. By the end of this video, you'll never look at a dividend ETF the same way again. Every week, there's a new video promising you financial freedom through dividends. And look, I get it. The idea is beautiful. You invest your money, you collect payments, you don't have to work. That's the dream. But here's the thing nobody talks about. Most of those videos only show you the yield, the percentage, the monthly payment. This ETF pays 8% annually? Great. But 8% of what? Because if that what is shrinking every single year, you're not building wealth. You're watching it disappear in slow motion and getting paid just enough to not notice. And that's exactly what total return is designed to reveal. Total return is simple. It's your yield plus your price change combined. That's it. If an ETF pays you 10% in dividends but loses 12% in price, your total return is negative 2%. You lost money, even though you were collecting payments the whole time. And this is where a concept called NAV erosion becomes critical to understand. NAV stands for net asset value. It's the value of all the assets inside the fund divided by the number of shares. Essentially, what your slice of the fund is actually worth underneath. NAV erosion happens when a fund distributes more than what its strategy can sustainably generate. This can happen through return of capital, through covered call structures that limit your upside while keeping you fully exposed to downside, or simply through payouts that are too high for the underlying portfolio to support over time. The market price of the ETF usually follows NAV closely, so when NAV erodes, the price follows it down. And that's when total return starts telling a very uncomfortable story. Let me make this concrete with an example. Say you invest $10,000 in a high-yield ETF. Over 3 years, you receive $3,000 in distributions, which sounds great. But during that same period, the price of the ETF drops from $10,000 to $4,000, a loss of $6,000. Your total position is now worth $7,000. You collected $3,000 but lost $6,000 in value. Net result, you're down $3,000, even though you were receiving payments the entire time. Now, in some popular high-yield funds, especially depending on your entry point and market conditions, the math can look very close to this. The monthly income feels real. The damage underneath is just slower and quieter. And if you were only watching the yield, you never saw it coming. Not all dividend ETFs work this way. And that's exactly the point. To help you tell the difference, there's a spectrum. On one end, you have what I call yield traps. Funds with massive payout numbers that the underlying strategy simply cannot sustain long-term. On the other end, you have dividend growers, ETFs, that pay you less upfront but whose total return compounds meaningfully over time. The key is learning to evaluate both sides of the equation together, not just the yield number on its own. Let's make this real with a comparison across 3 types of funds. Take SCHD first. The yield sits around 3 to 4%, which doesn't sound exciting. But SCHD has a long history of dividend growth, and while individual payments can fluctuate, the overall trend has moved upward over time. More importantly, when you look at its 5-year total return combining dividends and price appreciation, the picture changes completely. The price has grown, the income has grown, and your capital has compounded. Now look at QYLD, a covered call ETF that has historically paid around 10 to 12% annually. That yield looks incredible on the surface. But QYLD uses a strategy that caps your upside in exchange for options premium, and its 5-year price chart tells a very different story from SCHD. The yield is real, but the total return is significantly less impressive once you factor in where the price is gone. And then there are the ultra-high yield funds, some in the yield max category paying 30, 40, even 50% annually. The monthly distributions can be substantial, but many of these funds show consistent NAV decline over time because the strategy cannot sustainably generate payouts at that level indefinitely. In all 3 cases, the yield is the headline. Total return is the truth. Now, this doesn't mean high-yield ETFs are automatically bad. There's a specific situation where they can make sense. If you need cash flow right now, you have a large enough portfolio, and you fully understand you're prioritizing income over long-term growth. Think someone in or near retirement with significant capital who needs monthly income and isn't trying to build value over the next 20 years. That's a legitimate use case. But if you're 25 to 40 years old and still building your wealth, time is your most powerful asset. And eroding your NAV to chase a high yield is one of the most expensive decisions you can make with that asset. The message isn't that high yield is bad. The message is that yield without total return is dangerous. So here's what you do before you buy any dividend ETF. 4 questions, every single time. First, what's the 3 to 5-year price chart doing? Going up, staying flat, or consistently declining? Second, what's the total return over that same period, not just the yield? Third, how does this fund actually generate its distributions? From real earnings and dividend growth, or from option strategies and return of capital that may not hold up long-term? And fourth, what is your actual goal right now? Cash flow today, or wealth building over the next decade? Because the answer completely changes which type of fund makes sense for you. These 4 questions take 5 minutes. And they could be the difference between retiring with $800,000 or ending up with $200,000 and a pile of distribution statements wondering what went wrong. The dividend world is full of beautiful sounding numbers. But beautiful numbers aren't the same as real wealth. Total return is. Now you know what to look for. If this video helped you see something you weren't seeing before, hit like. It helps more people find this before they learn the hard way. And if you want me to run this exact analysis on a specific ETF you're considering, drop the ticker in the comments below. I'll cover the most requested ones in the next video. See you there.